makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, President Donald Trump has indicated that he's open to more trade negotiations, including with the European Union, even as he insisted that his letters threaten new tariff rates are the deals for U.S. trading partners. Well, let's bring in our panel, our great panel, to get us started on this Tuesday morning. Arend, Kapteyn, Global Head of Economics and Strategy Research at UBS Investment Bank, and our trade czar, Brendan Murray. Brendan, I mean, we're wading through documents trying to figure out whether this is the proposal of negotiations or is this actually a deal?
Yeah, well, I think that the whole strategy here is to keep the Europeans off balance, confused about what the president's intentions are. As you said, he said the letters are the deals, but he also said we're still open for negotiation. So the Europeans coming into this past weekend thought that they were trending in the right direction, and that they were sort of coming to some sort of framework arrangement, and then President Trump's letter dropped, and that kind of led to a whole nother a round of second guessing in Brussels. They're now trying to figure out whether talks are going to get back on track. There was supposed to be the chief negotiators of both sides were supposed to speak late yesterday. So we'll see if talks do in fact get back on track. But this certainly threw the Europeans for a loop to hear that their tariff was essentially just handed to them in a letter from President Trump.
And Brendan, at the same time, so the EU has also targeted countermeasures, right? They're going after U.S. car makers, Bourbon, and, for example, Boeing aircraft. So is this in retaliation or is this a deterrent?
Well, it's a message that here's what we're going to strike back with if you do indeed go ahead with these reciprocal tariffs. There is a lot of disagreement across the European Union about whether they should engage in what essentially would be a trade war with the United States. That would be very damaging to particular industries and countries. So there's going to be a lot of debate going forward over the next couple of weeks. And don't forget, before the August 1st deadline, the EU has a summit in Beijing with China, so they have to factor that complicated relationship into the equation as well.
Arend, I like the way actually your insights go through the 10 toughest client questions that we fielded. These are the questions that Brendan also fields every morning. And the first one is, how are tariffs impacting global growth? I mean, given we don't know where tariffs end up, how difficult is it to predict the economy?
Yeah, and what's fascinating is the market doesn't seem to care, and you look at the data, and data is getting really bad, right? So in April, we had the largest gap in 27 years between hard and soft data. So the confidence data was falling, the hard data was actually improving because of the front running. And then in May, you see that completely reversed. So you then see the soft data getting a little bit better because of the de-escalation, but the hard data at the end of the front running sort of rolling over. And if you extract a growth rate from that, you're tracking global growth about 1.3% annualized versus a long-run average of 2.8. So we're really seeing the impact now.
But Arend, I mean, so we speak to a lot of chief executives, also off the record or at least off camera, and they'll say, look, 10%, 15% I can live with. It's anything more that I haven't modeled. So is the market looking through because they assume that tariffs will go around 10, 15% level that the president had initially started with?
Yeah, it's partly optimism about the landing zone, and I think some of our clients think it might land lower, right? And I think the mood music the last 5 days is the other direction. And then the other thing is just not seeing it, right? So not seeing the impact in the data, and particularly inflation data, then sort of reinforces this false sense of security. Oh, maybe it's not so bad. Maybe it's like 2018-19. Now, I think that's a misread. So I think we're about 1 or 2 months away from starting to see the price transmission. It's a bunch of technical factors which we can get into as to why you're not seeing it yet.
Yeah, we'll get to that in a second. Brendan, what do we know about how, the Trump administration negotiates these? So there was, for example, there's a lot of animosity towards Russia. That's very different to what we had 4 or 5 weeks ago. And it goes, again, to the tariffs. So it's basically using tariff for a political message.
Yeah, exactly. So the message that we're getting from a lot of the trading partners of the United States is that they don't really know who they're negotiating with. Are they negotiating with the U.S. Trade Representative or Howard Lutnick, the Commerce Secretary, or Secretary Bessent at the Treasury Department, who himself is very open to negotiations? Where you have President Trump, who's basically like, the letter is our negotiation, and we're just going to tell you what the rate is. So there's a lot of confusion from on the other side of the negotiating table to the U.S. trade negotiators, that they don't really know how to deal with this situation. Is this just a big negotiating ploy, or is there actually a deal to be had before August 1st?
And Arend, I mean, why can't we see the tariffs in the data in the U.S.?
Okay, so we're going to get CPI, right? So there's a 2-month lag between the tariffs and seeing in the CPI normally. Now, one of the big problems is that almost all of CPI outside the 3 largest cities is only sampled every 2 months. So even if June was the print you're supposed to see in April, you're actually, a bunch of CPI is not sampled in June, right? So you wouldn't see it there. Then you have sort of complicated inventory dynamics. You have residual seasonality pushing down on the incoming data. So it's going to artificially depress, I think, the inflation print. And so really it's the July print, which you're going to get in August, when you're supposed to get a much cleaner read. Now, it could even be a bit later. There was an interview with the CEO of, I think it was Basic Fun, one of these big toy importers. And he basically said, look, we're still in the process of drawing down our inventories. We're not going to start to pass it on until September. Right? So I think it's coming, but we're not seeing it yet. Now, the one thing I would advise people to look at, the Treasury has daily data on how much they're collecting. They are now collecting tariffs at a rate of $330 billion annualized. That's already over percent of GDP. This is actually getting paid, right? So this is not somehow mysteriously disappearing. These are importers already paying the tariffs, and they're either going to have to take a big margin squeeze or they're going to have to pass it on.
But so the Fed, I guess, and Jay Powell is right to wait to cut interest rates.
Yeah, they're about to go into, we think, a 5-6 month period of accelerating inflation. Now, I think they know that. They run all the same models as we do. And so it's a trade-off between, I think, when does the labor market sort of start to ease and sort of crack, and we're seeing some signs of that, versus how quickly is the inflation data sort of increasing, and then making a judgment about, well, which of those two is moving faster and which will we respond to.
What happens to dollar?
So I think most of what's happened so far has been hedging flow, right? You do not see the rotation in the form of outperformance of bonds or outperformance of European equity. So, and I think what's happened now is the fast money community is sort of positioned for a weak dollar. They think the real money community still has to rotate, and so there's going to be some selling flow. Now, if you just run rate differential frameworks, the Fed is going to be cutting more than I think most of the other G10 central banks. So that would give you more dollar weakness. So the direction of travel is very clearly, I think, towards a weaker dollar over the next sort of 6 months.
Brendan, I mean, are the way that these tariffs put together, do they kind of save the U.S. economy, or are they at the moment blanket? So would it put some of the American companies at a disadvantage compared to others?
Well, I think the approach that the administration is taking, both with the reciprocal tariffs and the sectoral tariffs, you could say it's having both effects. The reciprocal tariffs, are going to they could be actually struck down by a court. So we don't know what the longer term future of those tariffs are. But the sectoral ones, the copper, the steel, and aluminum, we saw one on drones overnight. These sectoral tariffs will really hit the users of those commodities and those products that they can tack onto those 232 investigations. So there's going to be a pretty widespread impact over the longer term. But as Arend said, we may not see it till later in the third quarter or the fourth quarter.
Arend, I mean, the U.S. consumer has always showed up. Is there a danger that this time it doesn't show up anymore?
Well, so consumption has been much weaker the first half of this year than last year, right? And actually really weak in May. So when we're looking at sort of momentum, it's not very good. But we ask ourselves the same question. The last couple of years, it's all been about the top 20%, putting a floor under basically consumption. So you have simultaneously distress at the bottom end and then robust aggregate numbers. Could happen again, right? So using real income flows to forecast spending has not worked the last 4 years. That was pre-COVID, the way to forecast, but it hasn't worked. So I think that's one of the things we sort of ask ourselves, is that the way we're going to be wrong?
Yeah, so the top asked questions. I mean, I really love this note. At number 6, you have, what is the evidence of rotation away from the U.S.? I mean, people talk about it, but you actually see it in the numbers. So it was very clear in the April tick data, right? So there you could see the selling, and then since then, I think it's not so clear. And so you could look at things like, imagine you're going to reduce your position in the U.S. bond market and switch into bonds, which is 15 times smaller. Now, you should really see that in the form of a compression of term premium in bonds. You don't see that at all. There's no evidence of rotation. Oh, my earpiece just fell out. There's no evidence of rotation, I think,
out of the U.S. market into the European bond market. Then if you look at equity, there's been no outperformance of Euro stocks actually since April 2. So where it's showing up is really in things like the FX market, where it's more of a relative price.
Brenda, I mean, over the next couple of days, is it global tariff escalation? Is it all going to be like in the next 6-7 days, or could it really take for most of August as well?
I think the closer we get to August 1st, and as we get the CPI numbers, the beige book is on Wednesday, the PPI report is after that. We've got earnings season now coming into the picture and adding color to how the tariffs are affecting. I think where it's going to become clearer that this is the tariffs are something of a political strategy, but they're also going to become more of an economic drag as investors and others realize that these are actually taxes on American importers that the Treasury is collecting these taxes from, and I think that's going to become clearer over the next couple of weeks. And President Trump's argument for them, is going to come under a much larger test than it has to date.
Thank you both for joining us. Arend Kapteyn, Global Head of Economics and Strategy Research at UBS Investment Bank, and our trade czar, Brendan Murray. Coming up, China's economy grows more than expected, while exports of rare earth metals soar. We'll discuss the outlook for the world's second largest economy next, and this is Bloomberg. Welcome back, everyone. Now, Nvidia says it expects to resume sales of its made-for-China H20 artificial intelligence accelerator based on assurances from Washington that such shipments would be approved. Now, it's a pretty dramatic reversal from the Trump administration's earlier stance. Now, the H20 chip was created to comply with earlier trade curbs, but since April has been blocked from sale in China. Well, our news desk editor, Jill Deeses, joins us from Hong Kong. Jill, good morning. So how significant is this move?
Good morning, Francine. This is, I think, as you laid out there, very significant. I mean, remember, this is a chip that Nvidia had originally designed in order to comply with prior restrictions on China. Obviously, that was a really big blow when the U.S. Banned this earlier this year. So the fact that we've got a reversal, I think this is indicating really two things for us here. One, really big win for Nvidia, particularly CEO Jensen Huang, who just met with Trump last week. He's currently in Beijing, where he's expected to attend a conference. So you're seeing a pretty big victory for them there. Nvidia, likely going to then accrue billions potentially in revenue by being able to resume this chip. But then what it also shows us is that there's a pretty significant thawing here happening in U.S.-China relations. Now, remember, it wasn't that long ago, just several weeks ago, when the U.S. and China met in Geneva to sort of work out a trade truce. That pause on certain restrictions, it's actually due to end sometime next month. Although we've already started to see some de-thawing here, obviously in the form of these chip sales. We're seeing, some compromise being made, particularly so that the U.S. can facilitate, China to continue sending rare earths over, continue to include that trade. I'd also point out that the U.S. Secretary of State Marco Rubio kind of indicated last week that we're paving the way for a potential Trump and Xi meeting later this year. So I think, again, this is showing us some level of thawing in U.S.-China ties, and then also, again, a pretty big win for Nvidia here.
Jill, as always, thank you so much for joining us. Jill Deeses there with the latest on Nvidia. Now, China's economy grew more than expected in the second quarter, driven by strong exports to markets outside the U.S. But the data also showed weak consumer demand at home. Now, GDP expanded 5.2% year on year. Meanwhile, China's exports of rare earths in June climbed to their highest since 2009, indicating a push by global buyers to get hold of the materials used to make powerful magnets. Now, critical minerals, of course, being used to fuel the AI boom, to power the latest surge in defense manufacturing, and as a negotiating tactic, international diplomacy. Yet in a world of tariffs and trade wars, what happens to supply chains when China dominates a critical mineral space, both for mining the raw materials and refining them? Well, joining us now is Amanda van Dyke, co-founder and managing director of the Critical Minerals Hub, and Francesca Ghiretti, director of the Europe-China Initiative at the think tank Arend. So thank you both for joining us. Francesca, let's start with you. I mean, I was surprised that, despite the trade tensions between China and the U.S., China's doing okay. I don't know whether they've managed to reform the economy or they've just been much better at engineering it.
So they haven't managed to reform the economy. Some of the issues that have been structural for years are still there. We still have a real estate crisis. We still have youth unemployment, deflation, and we still have, as we saw, lower consumption compared to production. So the structural issues are there. What really went well to a certain extent is that they expected a much longer and much more difficult trade war with the United States. And at the end of the day, they had prepared for something a lot worse, and it didn't go as bad as they thought, at least, so far. And on top of it, even though trade with the United States has been less than in the past, trade with the European Union and ASEAN countries, for example, has increased. So they're diversifying their trade portfolio, so to say, globally, which is why their economy is actually part of why their economy is actually doing better than expected.
And it also helps actually having critical minerals, because they have so much of it, right? They have about 50 to 100% of some of the metals globally, yeah. And so it helps them internally.
Well, frankly, it's leverage. You were just talking about chips. Every chip that's made has something called gallium in it. China wants the chips, but the leverage they've got is if you want the gallium to make the chips, they're the only ones that have it. So their control and domination of critical minerals markets gives them huge trade negotiating power.
So is it because they have them, or they also have them at the best prices?
Both. Well, actually more. So they don't necessarily produce all of it in terms of mining it. What they do is refine all of it. So the end product that you need to actually put into whatever you're manufacturing is in China eventually, and they can choose to sell it to whoever they want, right? They have supply chains that lead to China, and then they can sell it to who they want. And that gives them control of the entire market, whether or not they produce it.
What does it mean for trade tensions and tariffs actually with the U.S.? Have they had at the margin a better deal because the U.S. still needs so many of these critical minerals? Absolutely.
So when the U.S., for example, has just invested in a U.S.-based rare earth manufacturer called MP Materials. The Defense Department invested $400 million. But it's going to take at least 5 years before they can start producing sufficient rare earths to even hope to be independent of Chinese dominance and influence. And in the meantime, all of the, let's say, car manufacturers, EV manufacturers who need permanent magnets that come from China are dependent on China. So it's a bit of a tit for tat. You want our rare earths, you need to give us trade concessions.
Yeah, and they've made this, they've made this approach, like they've basically rechanged, as you lay out in your nice note. It's 3 major changes in the approach to the country, and actually national security and critical minerals is one of those.
Yeah, 100%. I mean, usually export controls are adopted on the basis of national security concerns. So you want to protect national security, so you adopt export controls. Suddenly, export controls actually become a bargaining chip in trade negotiations or a leverage in economic statecraft. And the Chinese have become also much faster at implementing these export controls. If we go back to 2022, when the United States adopted the first export controls on advanced chips, it took China some 6 months to adopt the first licensing. In 2024, less than 24 hours. And then we saw in May also how quick they were. And on top of that, they're also learning from the United States to implement extraterritoriality, so asking third countries not to export any component that has their own rare earths within them if they're used in military applications by the United States. So we saw a real change in how China has been doing economic statecraft and using these leverage.
And we've also seen, right, to Francesca's good point, is that actually China has also gone to a lot of African countries, some Latin American countries, to have deals where the U.S. and others just weren't present.
Look, over the last 25 years, China has invested over $1 trillion in developing supply chains in resource-rich nations, especially in places like Africa. Some 70% of the copper belt is influenced by Chinese-owned companies. And that's a lot of influence. So if 70% of your copper and cobalt production in the Democratic Republic of Congo is owned by Chinese companies, and you want to say, okay, I want to sell to America, that's a lot of power. It's not that easy. When those commercial ties, they make diplomacy very difficult.
Yeah, and so I guess it's almost impossible for some of these countries to diversify away from China.
It becomes really difficult, not just because, the presence is so large. It's also a fact that a lot of countries who produce themselves and maybe they have their own companies, now they also have very high demand. So it's also difficult for these countries to decide to make agreements with third countries in order to export because they want to take care of their own home economy. We saw this, for example, with India and Japan recently, right? So they make it really difficult to adopt diversification strategies or stockpiling at the same time, which in theory are the sort of management strategies that you adopt while you try to develop your own production like the United States apparently is trying to do.
Francesca, overall, there's a belief actually in certain parts of the markets that it's really China that wins into all of this because the more turmoil, the more uncertainty with U.S. policies there are, then countries go to China. Is the president of China the real winner here?
It's difficult to say, but one thing that I'm going to say for sure is that that is how China perceives the situation to be. So they feel like they've been victorious, they feel like they have been vindicated, they've been telling people for a long time that the US was an unreliable partner, and they feel, this is actually what is happening, and they were right in preparing to become more self-sufficient and more independent.
Amanda, Europe has also, wanted to put this critical Raw Minerals Act together. But how does it achieve that? Can it achieve that?
So Europe last year put in the Critical Raw Materials Act in order to set largely targets for critical mineral independence. It takes a lot of investment, though, to create a critical mineral supply chain, and it takes a lot of time. What China has is that they're ahead, right? So right now, all of the batteries that we produce in Europe, they come from China, right? And China can decide. Recently, European car manufacturers have had delays on their production lines because they couldn't get the permanent magnets that have the rare earths in them. And so that's recreating. It took China 25 years to get this dominance. We won't be able to reassert dominance until we've invested almost an equal amount. And it'll take at least 5 or 10 years to claw back some of that independence. Until then, we're dependent on Chinese supplies.
And so this also means that China, does it mean actually that China has a natural advantage when it comes to AI?
Absolutely. So their AI advantage, there's technological advantages in terms of their learning systems and all of that and what they have. But they are dependent on a lot of American-made chips. But the chips are dependent on raw materials that come from China. It's a bit of they're both kind of holding each other to ransom, and how they figure out that balance is.
But do you think it gives them a big advantage? Is the ultimate race actually on what happens to AI, and is China that much more advanced?
So China is not that much more advanced. I agree with Amanda on a lot of points, but we should also bear in mind that, for example, a lot of the production of the advanced chips happens in Taiwan, not necessarily in China, or yet in the United States. The United States has an advantage in terms of design, which is why, we see Nvidia going to China and the Chinese being interested. So I do not think that China is winning the race as far as AI is concerned. They are codependent. So the question is, will they be able to decouple in some way? And that will determine who will eventually maybe win.
Thank you both for joining us, Amanda van Dyke and Francesca Ghiretti, for a good conversation on China and critical minerals. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. President Trump says he's open to more trade negotiations as the EU finalizes a new retaliation list of U.S. goods if talks don't deliver a deal. Nvidia searches Premarket on plans to resume sales of its H20 chip to China, a surprise reversal from the White House after its earlier ban. Plus, Donald Trump threatens 100% tariffs on Russia, giving Vladimir Putin 50 days to end the war in Ukraine. So U.S. President Donald Trump has threatened to impose stiff financial penalties on Russia if it does not end hostilities with Ukraine. Now, Trump said the levies would come in the form of secondary tariffs.
But we're very, very unhappy with them, and we're going to be doing very severe tariffs if we don't have a deal in 50 days. Tariffs at about 100%. I'm disappointed in President Putin because I thought we would have had a deal 2 months ago, but it doesn't seem to get there. So based on that, we're going to be doing secondary tariffs if we don't have a deal in 50 days. It's very simple. and they'll be at 100%. And that's the way it is.
Well, joining us now is Greg Sullivan, our Russia economy and government editor. So, Greg, good morning. Trump ratcheting up the pressure on Russian President Vladimir Putin. What's Trump exactly been saying?
Well, there's a few things here. One, we have definitely noticed a shift towards more frustration from President Trump with Putin. He's frustrated with the intransigence from the Russian side over reaching a ceasefire in talks that so far have produced very little. He's also frustrated at the continued missiles and drone bombardments on Ukrainian cities. He made that very clear last night when he was making his announcement. And in a more concrete step, we heard that the U.S. will be continuing to supply Ukraine with some defensive armory and artillery in that announcement. So that's what we're hearing from Trump. One thing of interest, though, was amid this threat for punishment for Putin if there is no ceasefire, he also opened the door to a 50-day delay. It's unclear exactly why Trump wants this delay or what he thinks he can accomplish or if he thinks he can compel President Putin to a ceasefire in that period of time. But he has basically given Putin a time frame here to reach that ceasefire of 50 days.
So, Greg, Donald Trump also keen to emphasize that the U.S. isn't paying for weapons for Ukraine. I mean, that seems like a novelty.
Yes, it's very interesting. This is something that Trump was very focused on during his campaign. He campaigned on ending or curtailing U.S. support to Ukraine. Several in his orbit have often complained about the money being spent on Ukraine or the diminishing of U.S. stockpiles. He was very keen to make the point that Europe and NATO allies would be paying for these weapons. That does sort of raise the question of what Ukraine will get will largely depend on what Europe is willing to pay for or supply, procure. But clearly, Trump is happy with the fact that he can say that this is not the U.S. spending this money. They will sell these weapons, but it is Europe buying them and then providing them on to Ukraine, something he has long sought.
Greg, thank you so much. Greg Sullivan there, our Russia economy and government editor. Now, the UK Chancellor of the Exchequer, Rachel Reeves, will make her annual speech to London's financial industry later at Mansion House, where she's set to highlight plans to encourage home ownership. It's a key moment for the Chancellor after a painful welfare U-turn and recent market jitters over her future. Well, we're now joined by Alastair King. He's the Lord Mayor of the City of London. I have to say, with the best medallion in town. Lord Mayor, thank you so much for joining us. What exactly is on the city's wish list, actually, from Chancellor Rachel Reeves that she could announce at Mansion House tonight?
I mean, I think there are certainly a number of measures that we'd hope that she would announce. I think one is a good idea, I think, would be a reform of stamp duty to try and make sort of UK equities rather more attractive in world terms. I think we have a very high level of stamp duty, and I think we'd like to see that changed. But I think also she could do an awful lot in relation to sort of setting the tone for the city and for United Kingdom financial professional services. We've seen her doing some really good things in relation to a reform for the Financial Conduct Authority. It's been a real change in relation to what they're doing and how they're regulating and the enforcement and all the rest. And I think that's been really appreciated. I think so. A bit more of that, I think, would be very welcome.
But Lord Mayor, how important is it that she gets the messaging absolutely right for the City of London, given some of the concerns around non-dom, and that may deter investment into the country?
Yeah. I think you make a very fair point. I think that there is a potential issue in relation to non-doms, and certainly I'd be encouraging her to think about that issue. Certainly, I've been discussions with government in relation to that. The thing I'd just say, though, is that having spoken to a number of big tax-related sort of advisors around the world, it wouldn't take an awful lot of a change to stop the numbers of wealthy people leaving, but also to encourage a whole tranche of others from the United States, from India, from other jurisdictions to come. So it doesn't need to be an enormous amount of change to let that happen.
Yeah, I was going to ask you, do you think these are permanent departures, or whether actually, if you think that there's not much needed to make the reversal happen, is the government listening?
Certainly in relation to my friends who've departed, all of them have done so with a very heavy heart, and goodness me, they'd like to come back. And in many cases, they haven't sold their businesses, and in some cases, they've left their families here as well, even though they've expatriated themselves. So I think that there is a great possibility of some of them coming back, but also to franchise so many of these others to come and join.
Lord Mayor, is there one thing that would really make a difference, actually, for the UK financial landscape to be a lot more competitive?
Well, I mean, I think that you touched on the fiscal regime in relation to personal taxation. I think that's absolutely right. But I think also, I always said in relation to growth for the United Kingdom economy, if you're going to get that, the city and the financial professional services sector, that's the first place it's going to happen. The buildings are already built, the people are already trained. I think you've got this regulatory system, although it needs a bit of tweaking here and there, it's still world class. The missing ingredient is confidence. What can the Chancellor do to install confidence? And I think that's effectively my role as Lord Mayor, as the Global Ambassador for Financial, Professional, Legal and Maritime Services for the United Kingdom, is to go around the world, banging the drum, attracting foreign direct investment, but also using my size 12 boot to kick British businesses to be more expansive, to be more ambitious when it comes to doing things abroad. And so I think some of that from the Chancellor as well, to say, so come on, let's do things. I think that installs confidence, and that's, I think, the bit that we need.
And I know you've been a great advocate, actually, for Britons to, for example, make sure that they invest enough in their pension fund to also invest in UK assets. Yeah. Is that working? Are they listening?
Yes, I think so. Certainly, we did the Mansion House Accord in May, and I think that's been well received, certainly well received around the world. But what we're trying to do is how do we make that self-sustaining? And so something we're announcing today is the employer pension pledge. We've written to the 50 largest employers in the country, and we've asked them effectively, could they make a public declaration that when they next renew their pension arrangements, could they please abide by the principles of value for money rather than pure cost? I think that way, if we go down the value for money route, effectively the possible pension outcomes are really impressive, and I think certainly better than they are currently when you have a whole load of equity trackers and all these sorts of things in pensions.
And Lord Mayor, when you talk about the Chancellor actually giving confidence, I mean, is this confidence in terms of the stability of tax regimes, or is it actually confidence in growth?
I mean, we like some stability. Businesses make better decisions when there's a stable environment there, and obviously taxes play a part. Plus, also general regulatory certainty. And I think sort of pushing in relation to our regulators for the competitiveness objective. That's something that was done 2 years ago. I think it would be good to see some real sort of solid, further solid outcomes from that competitive objective for our regulators.
When you speak to world leaders, I know you hosted President Macron in France just last week at Guildhall. What do they say about financial services? There's always, the French have always tried to attract, right, our bankers and our financial services. Is there a camaraderie on that?
I think that there's a bit of envy in relation to what London has, and goodness me, a lot of envy in that respect, because we have world-leading insurance business, world-leading legal services business. Here we have dominant position in relation to foreign exchange, plus excellence in asset management and also in banking. So there's a great deal of envy there. I think also, certainly what I spoke to President Macron about was saying that I think that France and the rest of Europe perhaps should think of London as a European asset. It's not just an asset for here in the United Kingdom. It's a European asset. Let's do more together.
Do you worry about big chief executives or businesses thinking of listing in the U.S.? I mean, this comes up over and over again because the U.S. could actually cut regulation and in general is seen as having a much larger, deeper capital pool.
It's obviously a concern, and they are very fierce competitors. And so what we've been doing here in London, though, I've been just in Mansion House, using that as a convening place to bring some of the really good tech scale-up businesses that are seeking to raise between £5 and £30 million to get their Series A, Series B financing rounds, get them up and running, because those are the companies that will be the really great sort of candidates to list on London when that moment comes. And they're much more likely to list on London if effectively the capital table is full of United Kingdom names. It's sometimes in the past what's happened is that American companies have invested in the earlier stage, the Series A, Series B, and then they've inevitably gone over to the United States to list. We'd like to change that whole program.
And so, Lord Mayor, when you look at regulation here, are UK regulators, do you think they will actually pause on extra regulation until they see what's happening in the US? Because otherwise, UK businesses will be at a natural disadvantage.
Well, I'm not so much in the sense of pausing to wait to see the US. I think that they've got a pretty good idea as to what's needed. I think it's some stability. I think sort of a better sort of elements in relation to enforcement and other elements. Yeah, I think that the regulators are really working hard to get a better, stable environment for British financial professional services businesses to thrive.
You can't come here with beautiful diamonds and not talk to me about it. What is it? It's a medallion. I mean, it's beautiful. It's
beautiful, and also it's very useful, Francine, because I go to conferences, and although people don't necessarily recognise me, they recognise the badge, so they know exactly who I am because I'm wearing this thing, and it's hugely helpful. People come up to me, "Hello, Lord Mayor," and it's lovely to have that.
But the history is again what the UK does so well.
Well, that's right, and I think the great thing is about it, though, my role dates back astonishing to 1189, so 836 years. But it has a lot of history, but also it has a very modern context to be the global ambassador for United Kingdom's financial, professional, legal and maritime services.
Just brilliant. You can come back anytime with diamonds like that.
I've been delighted. Thank you very much. I look forward to it very much.
Thank you so much, the Lord Mayor of the City of London. Now, staying with the UK, Thames Water has warned that the chances of a successful overhaul of its finances are diminishing. In a statement, the firm said there was now material uncertainty over whether a recapitalisation and restructuring can be completed. The company, the UK's largest water supplier, hinted temporary nationalisation may be on the cards. It says that it has enough liquidity to last for the next 12 months. Well, coming up, Wall Street's largest lenders begin reporting earnings today with JP Morgan and Citigroup first on the list. We also have an exclusive interview with the Mitsuho chief executive. That's coming up next, and this is Bloomberg. Well, Japan's third largest bank still sees the U.S. as a key partner despite ongoing trade and tariff uncertainty. The Mitsuho Financial Group chief executive Masahiro Kihara told us how he's factoring that into his outlook for Japan's economy and bond markets.
When there is uncertainties, it's a bit hard to invest for people, right? But I don't think this uncertainty will last forever. At some point, things will be figured out, and then the world will try to adjust. The corporates will try to adjust to a new world, and that will have a lot of opportunities for both the corporates and us too. So, I am very optimistic on what's going to happen in the future.
I mean, is this new world different from what we thought it would be? So, is it different markets? Is it different trading partners?
Well, U.S. is still a very, very important partner for us. We got 100 trillion export, and among the 100 trillion, 21 trillion is to U.S. So, yeah, I mean, U.S. is still an important partner for us, but I think we will also try to diversify that. So looking to other areas is also interesting.
Are you confident in the Japanese economy overall?
Overall, I think we still have strengths in the economy sectors that we have. So I think overall, I am very confident in that. The thing is that we have to concentrate our resources in the area that we have strengths. We have high quality manufacturing, high quality products. So I think we need to figure out where the strengths are and try to sell it to the world.
Do you worry, or are there dangers actually to Japan given the spike in long-term interest rates?
Yes. So 20 years. So for the long end, especially 20 years, 30 years, there has been spike and there has been volatility. But I think the government said that they will try to shift the issuance to a 10 years or below. I think the BOJ is a little bit shrinking its QT, and I think that will help.
But is there a point where it actually starts hurting your business and starts hurting the real economy?
Well, I think BOJ is saying that the neutral rate is somewhere around 1% to 1.5%. And on top of that, 10 years will be somewhere around 2 to 2.25% then. I think that's the level that is okay. But if it goes beyond to 3% or so, that will then hurt the budget, I think.
Are you expecting more turmoil in yen, but also in the bond market?
Not at this moment, actually. I think the current level of 1.4, 1.5 for 10 years is very. It's okay, I think. And we have. I haven't seen any turmoil in the 10-year zone. So as long as the 10-year is fine, I think it's fine.
And your thoughts on yen?
Yeah. So basically, if you think U.S. is decreasing the rates, and Japan is increasing rates, the yen should get strong. Yeah. Let's say somewhere around 135 level, probably.
Well, that was the Mitsuho chief executive, Masahiro Kihara, speaking to me a bit earlier. Now, the European Union has finalized a list of countermeasures to target U.S. goods worth 72 billion euros, including cars, Bourbon, and Boeing aircraft. Now, the measures represent the EU's response to President Trump's earlier so-called reciprocal tariffs. So we're now joined by Antonio Barroso, Bloomberg Economics Senior Geoeconomics Analyst for Europe. And geopolitics, geoeconomics, you do everything, Antonio, because everything blurs into one. It's unclear whether it's actually trying to get money in the coffers in the U.S., whether it's political pressure because of domestic issues. So, what do we know about the EU countermeasures? And are they a deterrent, or will they use them?
Well, we know that the initial list was targeting 95 billion euros, and now it's 72, which to me shows that actually EU leaders are trying to be strategic in the sense that they want to target the U.S., but they don't want to hurt themselves, right? Because if you target certain goods, maybe there are problems of supply, maybe there are problems of pricing. So I think that begs the question, what can the EU do if you don't have a deal? Because, this list of goods is just targeting the reciprocal tariff that was announced on Liberation Day, right? But what happens if you have that 30% that President Donald Trump has threatened? And then I think what you're going to hear, and you're starting to hear more and more, is the EU potentially targeting U.S. services, because the EU has a trade deficit in services. And you're going to hear about this tool called the anti-coercion instrument, which will allow the EU to actually put restrictions on U.S. companies.
Antonio, I have to say I'm confused on whether Trump sees the EU as a foe or as a friend, because his narrative has changed quite a lot.
Yeah, but it's difficult to know. Everything is possible in Donald Trump's world, and I'm not joking here. I think it really creates a lot of uncertainty because he wants to be seen in control. And when you look at how the negotiations have been unfolding, I truly believe that EU and US negotiators were negotiating in good faith. They were close to a deal, but then Trump wanted to be seen in control, and hence the letter that he sent to the European Commission President Ursula von der Leyen.
Do you see a resolution before August 1st?
As I said, anything is possible. I think it's entirely up to Trump. I think the EU was ready to accept a 10% reciprocal tariff, which, to be honest, is a one-sided sort of deal, so to speak. But they thought it would be fine to accept a 10% reciprocal tariff from the point of view of the US and maybe get some sectoral concessions. But it's entirely up to one man, Donald Trump.
Antonio, on France, we're expecting the PM to actually, try and outline a plan to narrow France's budget. How can he do it?
Well, that's the big question for everybody. I think Prime Minister François Bayrou is facing crunch time because so far he hasn't had to take any difficult decisions because, he doesn't have a majority in Parliament, but France needs a budget by law. And the problem is that he's going to probably unveil around 40 billion euros in cuts, in savings, maybe through cuts and tax increases, and the opposition doesn't want to take responsibility for it. So we might well see another political crisis towards the end of the year if the opposition decides to file no confidence motions against Bayrou in Parliament.
And when you look at China, so we had GDP figures today, what's the right way for the EU to deal with China right now?
Well, what they're trying to do is trying to get the Chinese to address the concerns of Europeans, mainly what Europe considers to be the export of industrial overcapacity. And they're trying to engage by going to Beijing. Towards the end of the month, there is a summit. But actually, things are not getting better. They're getting worse in the sense that Brussels perceives that China is not doing anything to address those concerns. So I don't expect the relationship to improve. Actually, I expect the relationship to worsen.
Okay, Antonio, thank you so much for all of your insight. Antonio Barroso there, Bloomberg Economics Senior Geoeconomics Analyst for Europe. Now, officials from the European Union are to hold talks with Elon Musk's X after the company's Grok chat box caused outrage by making anti-Semitic posts last week. including praising Adolf Hitler and the Holocaust. Now, the company deleted the offending posts and apologized, blaming a faulty update. It says the recent issues were investigated and mitigated. President Trump will announce a $70 billion in artificial intelligence and energy investment in Pennsylvania later today. According to an administration official, the plan includes new data centers, power generation expansion and grid upgrades, and as well as AI workforce training. Now, executives set to attend the launch include BlackRock's Larry Fink and the chiefs of ExxonMobil and Chevron. And Wall Street's 6 biggest banks kick off earnings this week, with JP Morgan and Citigroup set to report later this morning. Our Charlie Wells is here with a preview. Hi, Charlie. So what are analysts expecting?
Francine, there's a lot of optimism around the U.S. banking sector right now. If you take a look at this illustration of that KBW bank index of the major U.S. banks has been outperforming the NASDAQ 100 index so far this year. So a lot of optimism going into this, and there's reasons for this. There are expectations that some of the trading desks at these major U.S. banks should bring a boost to them. There's been a lot of volatility in the markets, and right-way wagers have been paying off for a number of these large Wall Street majors. You've got Citigroup on the FIC side really bringing leadership there. Equities, on that equities trading side, you're seeing Goldman Sachs reporting later this week. They really are bringing in a significant amount. They're expected to bring in a significant amount there. Also, if you take a look at net interest income, that is one of the most important revenue streams for a number of these banks, bringing in billions of dollars of revenue expected this quarter, and that is in this higher for longer interest rate environment that we've been in. But one of the areas where there's likely to be more of a mixed picture is on that investment banking front. We know there's been a lot of uncertainty. That's been great for these trading desks, not good for those M&A teams.
So, Charlie, are these results baked into bank share prices, which have been nearing records recently?
Francine, that is the question, and it really is sort of dividing the analyst community on Wall Street right now. We can see a lot of green on the screen so far. We see a lot there, but be careful not to read too far into this, according to some analysts who have taken a little bit more of a bearish tone here, the likes of Saul Martinez. I want to bring up some of these commentaries that show this split. Saul Martinez at HSBC talking about how a lot of this macro uncertainty actually might not be filtering into some of these share prices. Now, that contrasts with the likes of the take by, say, Mike Mayo at Wells Fargo, who's basically saying as long as there's not a recession, there is a lot of room to run for these share prices. And if you want to home in from this big picture take onto a single stock, we can take a look at JP Morgan. They are reporting in just a few hours, and you can see this split. About half of analysts saying buy, according to Bloomberg consensus, and about half taking a more significant, a more conservative stance here on that front.
So, Charlie, what gets in the way of banking's rally?
I mean, that's a great question, too. There are, of course, these trade tensions that we've been talking about, but there's also this split between U.S. large banks, these kind of national banks in that KBW bank index, and the regional banks. They have not been performing quite as well. And one take here from some of the more bearish voices has been that some of these big market moves that have been helping the large banks may actually be masking some trouble that is sitting in their businesses that are more in line with some of those regional banks.
Charlie, thank you so much. Charlie Wells there with the very latest on some of the bank earnings out of the U.S. Now, coming up a little bit later, the U.S. Treasury Secretary Scott Bessent joins Bloomberg Surveillance. That's at midday, London time, 7 a.m. in London. Actually, 7 a.m. in New York. It's a little bit later in London, 12 p.m. in London, so you don't want to miss that. Up next, Bloomberg Brief, and this is Bloomberg.